Hello and welcome. You're watching The Investing Edge. I'm Sumaira Abidi. Investors today are no longer content with just a one-dimensional approach to investing. They want a lot more. They're looking at portfolio diversification, more efficiency in tax planning, better alternatives in terms of passing on wealth to the next generation, and perhaps even philanthropy. The Investing Edge is the answer to all of these questions and much more. With me is Feroze Azeez, Deputy CEO of Anand Rathi Financial Services. Feroze, thanks very much for joining in for yet another episode of The Investing Edge. And to begin with, before we talk about investing, I want to talk about the current environment that we're investing in. There are global worries that are going on. There are slowdown worries in India itself. There's the recent debt market scare that investors have seen. Therefore, what should be a holistic investment strategy at this point?
I completely agree with you, Sumaira. As we progress, the world is going to become more and more complex because it will all be jumbled up. So it's going to be difficult to ignore risks. Risks are very important because that's the only thing you control. Returns you can only pray for. Risk is the only thing you can keep an eye on and mitigate. The risk is that there is artificial money in the global market. It's not real liquidity. Half the Europe has negative interest rates. You give your fixed deposit to a bank and he returns 99 rupees as against 100 rupees. That's like unimaginable from an Indian context perspective. Of course, the liquidity has been far more than it deserves to be, is why you have such low interest rates. Okay, there could be supply shocks. If China stops doing trade with the US, there could be supply shocks. So inflation can shoot up and still interest rates can be low. So there are quite a few risks which are there. You have to only worry about risks if you don't have a strategy. If you have been buying products, you have to be really worried because there was no risk target. Do you have a risk target? How do you measure the risk? How do you put a target to it? If you have a target and you've controlled the risk, it's okay. There are 4 risks you need to be concerned about. How are they measured? What is your measurement? What is your interpretation of those measurements? And what is your mitigant? How do you reduce those 4? If you have not done that activity, or if your advisor has not done that activity adequately enough, then the risk can impact you. Strategic approach helps you be lesser worried because you can have risk limits. Second is, you should always have a plan A and a plan B. If equity markets don't do well and something catastrophic happens, what is my plan B? If you have these two, then these external risks are going to be there. If you keep going 10 years, every year there was some risk or the other. Right? So you have no choice but to live with them and maneuver them safely.
That's true. Actually, a lot of people think that they're in the business of delivering returns when actually they're in the business of actually just managing the risks better. But since you've spoken of risks, let's talk about some of the risks in our environment, right? You spoke of interest rates, but let me take that point forward now to bond yields. In India, the benchmark bond yields, have come down swiftly, now below 6.5%, I think 6.3 or thereabouts. What is the debt strategy for an investor in this environment where yields are falling? As well, the debt funds themselves have come under question because of, some credit risk events, et cetera, et cetera. Therefore, how much place does debt have in a person's portfolio now?
Is debt important? In India, debt is very important. Why is debt important? Because it gives you 8% interest, 9% interest. So it is high enough to be attractive to be a part of the portfolio. Right? So debt is an important part. One method to make money is to lend to people who give you higher interest rate. That's called credit risk strategy. That's called credit risk strategy. The second way to make extra money in debt is called interest rate risk strategy. The third is to dynamically manage it. We think debt in our portfolio should be there for safety. Don't play around too much with debt because the purpose of debt itself is to provide safety. Risking your safe capital is itself counterintuitive. So point 1 in our debt strategy is don't take risk in the component which is supposed to infuse stability. So in debt, don't take risk is the first step. Second is invariably you will automatically get credit risk. There is no choice. In debt, you have to your credit risk automatically comes. Interest rate risk is a choice. If you take credit risk, make sure that you are lending to 150 companies, not to 10 companies, 20 companies, 100 companies. If you can in effect lend your money to 150 companies, if 4 of them went down under also, you know 146 of them are alive to pay you back your money. When you buy debt mutual funds, which are a very good vehicle, you can only see the name of the fund. But inside that fund, the fund manager has lent to 30 companies, 40 companies. Only seeing the name is not enough. Seeing the underlying instrument inside the wrapper, like you have a wrapper which is called the mutual fund. What are the companies inside? So now, for example, now my portfolio has 8 credit risk funds. If you buy those same 8 credit risk funds, you will get 170 companies. You have lent to 170 companies. The top company itself, the biggest money is lent to a company where I've put only 4%. So even if the largest company whom I have lent to, I have lent 4%. If it goes bankrupt, it'll hurt me, but not so much that it'll break my back. So diversification is the strategy. Interest rate risk should not be taken. There is a mathematical evidence to it. Interest rate risk is one of the most meaningless risks to take. Quite a few people recommend that: income funds, dynamic bond funds, GSEC funds. Mathematically, you know that it's a zero-sum game.
Feroze, I've heard you say so often that people keep buying products all their life. They don't know what to do with it. Everybody comes to the product, they buy it. I know that you only have preference for 2 or 3 products, right? Why don't you like real estate? Why don't you like, other products from these 17 or 18 product categories that are available? Why are you fixated with just the 2 or 3?
We realized that none of these are good for our clients because we went the full circle. Between 2004 and 2012, Anand Rathi did a lot of exotic stuff. So we did all that and we realized this is very experimental and the client is not benefiting enough. And in fact, we stopped the real estate fund, and I commend my promoter and I take immense pride. We got a negative view 5 years back on real estate, which today everybody agrees real estate is in shambles. 5 years back, we wrote articles and we became very negative because data was saying so. AIF's not good, PMS not good, ULIP's not good. Right, real estate funds not good, mezzanine lending to builders not good, perpetual bonds not good, right? So, and there is enough evidence, okay? It's not off the cuff, okay? In fact, buying and selling stocks, direct equity for a long-term investor is detrimental. This is product classes. If you just eliminate this, your return will go up to 3%. You don't need to know what you need to do. You just need to know what not to do.
Okay, so what's the outlook now going ahead? You've narrowed down on the products. Does the investing style or strategy change with the changing environment? Does that remain static? Is there some sort of hedge that's required?
If you can identify trends and invest and incorporate them in your strategy, what are the trends? Clear trends. One trend is markets will be driven by domestic liquidity. Why? Because 10,000 crores is going to be spent in educating people on what mutual fund is. 10,000 crores in the next 10 years. So what is going to happen is when you're educating people, there are only 2 crore Indians who invest in mutual funds out of 138 crore people. In the US or any emerged market, 50% of the population invests in mutual funds. So with this kind of expenditure, will there be 10 crore investors in the next 10 years? I think so. Second trend is India is going to be far, far, far more tax compliant. Identify trends. Don't be worried about news. If you know what are the 4 or 5 trends, which are very, very high chance, then if you incorporate them in your strategy, you'll be okay. Second, how do you monitor? And how much do you monitor? So a full-fledged review of your strategy every year, monthly review with an advisor is a very good practice, where your next generation or your spouse is sitting along is a good frequency of review.
On that note, we'll take a very quick break. We'll come back and answer all of our audience queries in just a bit. Do stay tuned. Welcome back. You're watching The Investing Edge. This week we're in Bangalore and we have a lovely audience who have a lot of questions. So let's get started. Yes, sir.
Talk about the structured product. I was privy to it in one of your earlier sessions. So my question is, there is a protection there for downside and so on. I would like to know, for a retired person where safety becomes very prime, is it okay to kind of put 75%, 80% of your money there, and what's the associated risk?
Correct. So structure products have their merits. They also have their demerits. Would I recommend anybody to have 70-80% in structures? The answer is no. It is by far my favorite product, and data says so. It deserves to be the favorite product because of several reasons. But 40% is what we recommend to our clients can go into structures. Disadvantage of structure is capped return. If there are returns which markets give which are extraordinary, which happens every 8-10 years, then a structure product does not give you a return which is overwhelmingly very good. So a structure product will tell you 75% return in 3.5 years, for example. Even if the market tripled, it will still give you 75% return. But it's a good thing because it's a plan B. That's one disadvantage. The second disadvantage is credit risk. What do you mean by credit risk? Now, the structure products which we issue, I used to buy structure products from other platforms also for my clients. Then I realized that I don't want to give my clients money to somebody else's balance sheet when I don't know what is happening there and I have zero control. So the balance sheet which gets managed has to be right under our nose to smell and manage it properly. That's why we do an Anand Rathi structure. And one very important thing, when you speak of credit risk, anybody speaks of credit risk going forward, if you think it makes sense what I'm saying, you should always ask this score. You should say, what is your Z score? You should ask for my Z score, which is a synopsis or a comprehensive way of expressing what risk I have taken in my company. Z score, Altman Z score.
See, we've been hearing that investment is a lot of guidance. People are giving it. But at the end, we get confused that how you distribute your asset, total investment between the equity shares, or mutual funds, or fixed assets, or any other investments. Because everybody says that you have to balance it. But sometimes we don't know how to balance it and when to come out. Most of the time, we get advisors to enter. Exit, nobody suggests us.
So I'll describe what is the allocation of the standard portfolio. So what does this portfolio do? It invests 65% in equity, 35% in debt, 0 to real estate, 0 to gold. Real estate is going to go through a huge transformation, and it is in the stages of how unregulated equity was in the 90s or the early 80s and 90s. So real estate is going to go through a lot of regulatory changes. So that's the reason. So that's one expression. Asset allocation 65-35, gold 0, and real estate 0. And product selection only 2, mutual funds and structure products. With mutual funds and structure product, you can create portfolios. You don't need any of these PMSs, long short funds. You have, name it, and I can tell you variety which will make you feel that you're being given something, such an exotic kind of a thing, but that's going to be not good. So 2 products, in that 60% in mutual fund, 40% in structures. So 4 components, 39% in equity mutual funds is the component, 26% in equity structure, 14% in debt structure, and 21% in debt mutual funds. This is the standard portfolio.
The reason we are asking this question is because I'm pretty sure that on the taxation side, it's a very painful thing to sort of get into, and therefore you just, it's just a chore that you do. So just wanted to know what some of the ways are to really optimize it, because that's something that you spoke about.
Correct. So, of course, one is taxation optimization. The simplest thing is defer it, right? Now, for example, if you paid like a fixed deposit, you have to pay the tax every year. Investments, you have to pay the tax when you exit. Now, for example, we have structure products which extend, they are 3.5-year structure products, but they can get extended for 7 years. What do I mean by that? At your choice. So if let's assume my 100 rupees became 175. So you got a gain of 75 rupees. You can, whenever you take the money, what do you mostly do? You reinvest it. So what do you have to do? You have to pay tax at the end of 3.5 years on the gains you have made of 75. If you are anyways going to reinvest it, you can also choose to say that extend it by 3.5 years. Then what happens is, the tax which you were supposed to pay on your 75, let's assume 10-15 rupees, that is also there with you for the next 3.5 years to grow further. One way to manage tax is to defer it. Understood? That's the most simplest way. Now, Section 73 has a lot of SOPs for people, lot of gifts for people, like short-term capital gain of equity can set off 43% tax items. Okay, what do I mean by that? See, if you sold a debt mutual fund, before 3 years, the taxation for you is going to be in the range of 33 to 43, depending on how much you earn. Section 73 allows you to set off this higher taxation bracket with losses you made in equity, okay, which is an anomaly, right? So how do you do it? Now, for example, markets were bad last year. After September 2018, after the ILFS episode, market came down from 11,700 and still 9,900. What should you do? You would have made some losses. Those losses are temporary. You don't have to worry. But can you switch your money between growth and dividend? So what I'm saying is, whenever you see bad news, you would have made some losses. Book those losses. If you are sitting in a mutual fund, let's assume Reliance Large Cap Fund, dividend option. You know that you have put 100 rupees, it has become 90 rupees. Nothing to worry, because it will come back to 110 someday. But when it went to 90 rupees, if you just stayed quiet, you will not get any tax advantage. But on that day, if you switched from dividend to growth, same fund, you will get 10 rupees loss. What did we get? We got a 10 rupees loss. That 10 rupees loss can be used in the next 8 years to set off against real estate gain. You can set off this loss against real estate gain. You can set it off against gold gains. You can set it off against debt fund gains. So that's Section 70. I'm giving you an illustration. The point I'm making is, at least begin the journey of writing down the tax is my objective with your advisor.
So I want to know, like, what are the best 3 investments you would suggest which would give good returns with, minimum risks?
Very good. So this expression of desire of every investor has been solved by a person called Markowitz, okay, using a theory which won a Nobel Prize. Because you are absolutely right, everybody wants the maximum return with the lowest risk. So there is a model called capital asset pricing model which was invented, which tells you that for this risk, what should be the maximum return you can get. So at 7.5 standard deviation, firstly, if your desire is minimum risk, you need to numerically tell me what is the minimum risk. Of course, if you begin the journey today, after 5 years, you will say, Feroze, what is the maximum return you can give me on 4 standard deviation? Like Mr. Rathi gives this mandate, 12/4, which means he wants a return of 12, risk of 4. Have you told your advisor what is the risk target? If you have told that, great. No treasury guy will accept work without he being given a risk target. How do you get a portfolio which has the maximum possible risk? Markowitz says that at 7.5, given all the assets, the maximum return should be 16.8. Okay, but is the portfolio the most efficient, which I recommended? No, because it was 15.24. But it's as close to the efficiency as possible. So that's how we measure it. So Markowitz is a very, very good method to create the portfolio. So the 8 funds chosen, I said the same 8 mutual funds you should follow and I should follow. Those are chosen on the basis of Markowitz. So mutual funds and structured products both equity, debt are the best investments if combined in the right proportion. Then coming to the consistency bit, consistency will come if you have a strategy. If you look at the standard portfolio recommended from 1st April 2014, if you saw every year returns, you will see that the range is narrow. So if you want to aspire for 12% consistent is possible. So you would, on a worst year, you will be at 5, on a good year, you will be at 15.
Your view on why gold is not a good investment at all, or even otherwise silver also, because traditionally it has been a good investment.
So asking why zero in gold? Very valid, Sir Benji. So gold is not an asset. Okay, it's a currency, and I'll substantiate my big claims. Gold stores value. It always used to store value, but it is being treated as an asset. I'll explain why it's not a good asset. Gold has not given return. Of course, my mom debated with me, what are you saying here? I bought gold at 3,000, it is at 33,000, what are you saying? Gold has not given the return. It is the dollar which gave the return. Is gold a patented Indian asset? No, like a stock, Bangalore-based stock, Infosys. I would say Infosys is a stock which is an Indian stock. Is gold an Indian asset? It's a global asset. In dollar terms, gold is the only asset which gave negative return for 25 years. You will not believe this. Gold price in 1979, the year which I was born, was $800 an ounce. It went down. It didn't come back to $800 an ounce till 2003. That's a negative return of 24 years in dollar terms. But in rupee terms, gold is wearing a very pretty jacket of dollar. Gold price has not gone up. Rupee has depreciated. See, when you see 3,000 has become 30,000, even if you took the dollars, gave it to your NRI friend saying that keep it in a drawer, don't buy gold, and then when you took it back from him, your 3,000 would have not become 33,000, it would have become 28,000. The last 2 decades, India is the highest consumer of gold. So much so that if you leave the top 5 countries, we are the highest. If you leave the top 5, the rest of the consumption of the 195 is lesser than our consumption. If gold was such a good global asset, why are we not the richest country? You understand? Because it helps you buy dollars. When you buy a bar of gold, you have bought gold and you have also bought dollars. You in effect buy gold and dollars. Gold bars should be banned in your portfolio. You can still buy gold as sovereign gold bond. It is the best thing which can replace all the gold which you have in lockers in bars form. When you're wearing it as jewelry, then it has several merits. There are 2 very big advantages of sovereign gold bond. If you have a bar, sell it and buy the sovereign gold bond. It has not reached you, these advantages have not reached you because Modi ji decided to not give commissions to us. You will get 2.5% interest on your gold. Gold price there. And any gain you make on the capital gain side, if the 33,000 became 1 lakh, all the gain you made is tax-free if you held it till the expiry. So you get tax-free gains. If you buy a bar and hold it, you will pay 24% tax. If you buy it in the gold bond form, you will pay 0 tax on the capital gain. Today, equity also is being taxed. Only sovereign gold bond and ULIPs are left. Sovereign gold bond is not known so popular. ULIP is very popular because the commission is 40%. ULIP, so everybody would have had ULIP. Sovereign gold bond, not more than 1% will raise their hands in this room. So if you have gold bars and if you have an objective of getting your child educated abroad, gold is a good asset because it's helping you buy dollars also.
Feroze, thanks very much for answering all of these questions and for furthering the objective of better wealth management practices. Thanks very much indeed, and thanks also to all of our audience for joining in this evening. With that, we've come to the end of this episode of The Investing Edge. Thanks very much for watching. Do stay tuned to CNBC TV 18.